One of the many benefits of being a Mott's Wealth Management client is the opportunity to meet and speak with industry specialists and professionals. Our speaker for the Forecast 2013, past and present, is Melissa Motts, president of Mott's Wealth Management. She has over 25 years' experience in the tax and financial industry, is a CFP, CPA, and has a master's in taxation. This presentation was recorded on February 21st, 2013.
So I want to welcome everybody to our Forecast 2013 presentation tonight. Our objective at this event is to evaluate where we've been, where we are, and where we may be going. So 2012. So U.S. domestic stocks up 16%. Global, Russell Global, without the U.S., was up 17. 10-year treasuries, 1.78. Gold, 5.7. And crude, 3.5. So 2012 was a big year of uncertainty. And looking back, the political turmoil definitely dominated the headlines. Sometimes it's hard to remember back a year, what was going on last year. Here we have Mario Draghi, the head of the European Central Bank. If you remember last year in the spring, there was a European debt crisis going on, which was quite, hit the markets, was quite anxiety producing. Then, of course, we had the presidential election, close race, and then the fiscal cliff. So that was not too long ago. Big drama, lots of big drama. And with uncertainty, when you have these are uncertain, right? Is Europe, are they going to bail the banks out? What's going to happen? What's going to happen? And markets do not like that. And then, of course, the presidential race, big differences between whoever won as to where things were going to go in the country. So a lot of uncertainty. And then, of course, the fiscal cliff, big uncertainty, especially if you're trying to plan future purchases. If you're a business owner and you're trying to figure out how you want to spend your money and so forth, you have no idea, what's going to happen here. Another thing that happened last year, which maybe was under the radar a little bit, was the Supreme Court decided to uphold the Health Care Act. That was another big one they were waiting on. Pardon me? Except for one part of it, yeah. But the vast majority was upheld. Okay, and of course we know the fiscal cliff. So last minute actually was in 2013, really. And for those people that do taxes for a living or try to advise people or plan on taxes, I can tell you, I was sitting there at the end of December. Should I sell? Should I sell? Because I had no idea what the capital gains tax was going to be, a few days later. Anyway, they're permanently enacted, these tax cuts, which is a big deal. And the alternative minimum tax, which has been a patch every year going on, permanently enacted, finally. So there were some really good things that came out of that. I have to give the politicians credit for that. So we don't have all this uncertainty over and over and over again. But then, of course, one of the things that didn't even make it onto the slate was the 2% Social Security tax. Everybody probably noticed that in their first paycheck. If you get a regular paycheck, you saw your net go down. So that went away. That was temporary. That was to help with economic stimulus. And Walmart actually, it was just this week, their stock went down. Now it's back to about where it was. But they said this February was the worst start to sales they've ever, not ever, but in the last 7 years they've seen. So, it impacts people, especially people that are spending every cent that they earn, 2% of their pay. That makes a difference. It's estimated that the deal will add $4 trillion to the deficit over the next decade. So by keeping the rates lower, keeping all the credits for education, there are all kinds of things that were maintained in that bill, it's going to add to the deficit. There are some things that people don't realize. It's pretty much if your income is $450,000 or higher, your tax rates go up. Starting this year in 2013, if you're a married couple, single, it's $400,000. They're starting to take away the deductions that you get for your itemized deductions for a married couple over $250,000. So it's kind of a backdoor way of increasing your taxes. So that's going on too. And then there's the extra health care tax this year too. So there's a lot of things happening in the tax world. And then, of course, they kicked the can down the road on spending cuts, which now we have another issue next week, February 28th. Will Congress be able to get it together and, take care of that? It comes around before you know it. All right, QE3 and QE4 and infinity. So that's quantitative easing, which means basically the government, the Federal Reserve Bank, they buy government debt, U.S. government debt, and mortgage-backed securities. They do that to put money out into circulation so it can be reloaned. And then they hold the assets. One of the things about that is what they're trying to do, we've been in a deflationary environment as the credit bubble burst in 2008. So they keep trying to reflate it. It's like a balloon that's trying to, it's like the air's coming out of it and it's going down, 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 and they keep, blowing it in to keep it up so it doesn't keep going down. So they have been successful, in that we haven't gone into a recession here yet. The fourth quarter, our gross domestic product was negative, but we'll see what happens after this first quarter. Today, the Philly Manufacturing Index came out. It was a negative 12, which was totally off everybody's radar. Nobody was expecting that much of a decline. So that's part of the reason why the market went down today. So much. And then also there is not just our Federal Reserve, but global central bank coordination to force interest rates lower. You think about it. Last year, one of the big problems when the European debt crisis was happening was Spanish and Italian bonds the rates were going way, way, way up. And governments, they can't pay that interest. They can't afford to do it and pay all the other things they're paying. So it's coordinated. Bank of Japan, since the beginning of the year, and in Japan, gasoline prices, food prices, the price of gold is the highest it's ever been in Japanese yen. Just in the last 3 months, their inflation level is just going through the roof. Because Japan has been in a recession, meaning their economy is contracting. And they depend a lot on exports. So the best way to try to get their exports out there is to make them cheaper. The way they make them cheaper is print money. Print money, print money. So what that causes is inflation for their citizens. And those are the things that could be a problem. The other one now, the British pound, is some weird things going on there too. So, you have kind of this coordinated effort. If it's coordinated, it's okay. But when they start competing with each other, as far as one government's trying to outdo another, outdo another, then you can have a real problem. And we're seeing some of that. The intent, the second bullet point, is really important because, the intention is to force people out of safe investments, right? You get tired of earning nothing on your money market account, your savings account. So it's forcing people to take on risk, get that money out into the economy. That's what the government wants. You have to take on risk. They're called spreads. It's the way that bonds are valued. They're called high yield bonds. They're not rated, so another term for them is junk bonds. But they are at the lowest yield, like ever. So, people are searching for income. We have more and more people retiring, the baby boom retiring. So it's definitely an issue. And then also the ECB, or European Central Bank, by saying that they would support the euro. That was the big thing last year. A lot of fear around, would Germany leave? Would Italy leave? Would Greece leave? All that. We have elections coming up this weekend in Italy. And there's an anti-euro candidate who actually has picked up a lot of support recently. So we'll see what happens there. I'm mentioning this not to scare everybody, because there are a lot of good things going on, and I'll talk about that too. But it's just, there are these underlying risks there to be aware of in this environment. And China. So this chart shows their GDP, so that's the growth of their economy. And that top line is 14%, and that was in 2007, the top blue one. So that's a lot of growth. Over 8% a year they've been growing. But you can see how it's slowing. Okay, but they're not in a recession. But the growth of their economy has really helped, the rest of the world, especially Japan. Japan's a big partner there. So Chinese stocks had a very rough 2012 until their new government came in and said they were going to, spur the economy and have all kinds of building and spend money and so forth. And then you see what happened at the end, literally, the end of the year, very end of the year into January. So it was a pretty big decline there in the summer, over 20%. Okay, this I find interesting. So last year, the S&P 500, that's the top 500 companies in the U.S., just under 90% of the growth in the index came from 10 companies. Biggest one, Apple. Yeah, Facebook wasn't in there. They weren't in there. So the biggest one was Apple. The second one there, the gold one, was Bank of America. AIG, that name ring a bell? Goldman Sachs, Wells Fargo, JP Morgan, Citigroup. How many people, you know, like a year, like at the beginning of the year, would have put so much money into banks? Yeah, big risk there, you know, but they outperformed. Yeah, as well as IBM's in there too, GE. The one thing I thought was interesting, I went back and looked at 5 years ago. Goldman Sachs was trading, so I did these as of February 12th. Goldman Sachs was trading at $178 a share. February 12th of this year, 5 years later, was trading at $153 a share. AIG was at $977 a share 5 years ago. This year, on February 12th, it was $38 a share. Citigroup was $255 a share. Now it's $44. I mean, it was in the single digits back in 2008, Citigroup. So it's come back a lot, but still a big loss from where it was. Bank of America was $42, now it's $12. And Apple was $125 5 years ago. And on February 12th of this year was $468. Now that's a nice gain, but if you bought it in summer, you would have lost a lot of money between then and now. The most money went into that came in when they were over $600 per share. That's what, you know, it's like a parabola, just shooting it up. So housing is stabilizing, and that's a really wonderful thing for our economy, because housing, you know, improvements, new houses, etc., they add a lot of jobs. That's very labor intensive. So that could be a real good thing. So it depends. I mean, I still talk to people that say there are a lot of houses still out there for sale, you know, and the banks have them, they haven't released them yet, but, you know, in general, they seem to be really stabilizing. You know, interest rates have gone up a little bit, mortgage rates, but they're still pretty low, very low, actually. So this is interesting. So this is looking at U.S. unemployment rate by education level. We can see here that less than high school, that's this top line here, 12%. And that's the reported U.S. unemployment rate. You know, a lot of people are working, but they have part-time jobs or a couple part-time jobs. So you can see how high that is. For bachelor's degree and higher, it's under 4%. So there's getting to be a bigger and bigger divide between those with education, those without. And then food stamps. I mean, a lot of college kids are on food stamps now. It's really amazing. Really amazing. You know, and the problem with that is, you know, that's unsustainable. You know, the less people that are working and the more people on food stamps, and that's more money that's going, we're paying into taxes that are going out in entitlements. You know, so that's part of the problem with the whole, you know, this sequester that's going to be coming March 1st if our government doesn't do anything about it. So that is referring to there's $1.2 trillion of spending cuts spread over the next 10 years that are going to commence on March 1st, so next Friday. And just to give you a little history about that, that's from in 2011, a super committee was formed. 2011, we were downgraded, the U.S. debt. Okay, so part of that was we had to get our act together, fiscal act together. Of course, they couldn't agree, so it became an automatic. This is what happens. So they're across-the-board cuts. And I'm reading things, you know, about furloughing employees, et cetera. I mean, things that could affect us would be like the FDA, you know, they inspect your food. So you could see shortages of things, you know, I mean, so these are all the, you know, all the news. I don't know if it'll actually happen, but we'll see. So that's austerity. That's called austerity. Okay, so where are we? So we've got this new environment. We call it fat tail risk in our lingo here. So you can see the top graph there shows the probability. This is before the credit collapse. The tails, which are these lines that come right out here, see how they're just about on the line here, over there and there? Well, after, there's space in between here. And what this space represents is probability. very low probability, much higher probability on either side. And what that means is you have the higher probability of one-time event moving the market. And we see that. You know, that's one of the concerns I have. Minutes came out yesterday from the Federal Open Market Committee, and they said they're divided now as to whether they're going to continue with the quantitative easing. And 2 o'clock, stock market, down after that. Okay, after that came out. Because when you look back in our history since 2008, okay, the first quantitative easing started in 2009, I believe it was. You know, asset values went up. It ended, big decline in 2010. Quantitative easing 2 came up again. But what we're seeing is every time they're doing this, the effect is becoming shorter. The length of time that it's affecting, you know, keeping things up is getting shorter. So there's definitely risk there. So structural issues, you know, these structural issues won't solve themselves. So, you know, the political will has to be there to take care of these things. And it's, you know, in my opinion, it's hard to do. It's really tough for them to do it because they're going to look really bad if they, you know, do what they are supposed to be doing. And you have, you know, examples like we see over in Europe where countries like Greece are in a depression, you know, and people are, I mean, you know, they're in really bad shape. And so austerity is pretty much being forced on them by the countries that are, much better shape. I mean, I'm not saying what's fair or what isn't, but it's just, it's the reality of it. So it's a tough decision here. So we'll see if we can, if they'll be able to work together this year. It's not looking so good. Corporations, you can see here, this top line here was the third quarter of 2011. And then we had the fourth quarter, first quarter of 2012, second, and then third. You can see how much business spending went down. A lot of that had to do with concern about, or the uncertainty over the tax situation, what was going on. So that's not a good sign, you know. And then, like I said today, the Philly Fed index coming out and having a negative GDP number for the fourth quarter was not good either. So, you know, we've been able to escape recession so far, but it's tough because Japan's in recession. Europe's, you know, had a negative GDP. You know, I don't know how long we'll be able to escape that. We'll see. So, and what that means for your investments, typically recessions, markets go down. But Germany's hit a high. And they're in the middle of a recession. It's so crazy because of all this money printing. It's so taken the natural forces of the market, really skewed them out of whack. So, you know, and I have a saying, it's like, don't fight the Fed, you know. You go along with what they're doing, you know, until it's not working. Yeah, and China is improving too. So that's a good thing with their new leadership. So U.S. stocks, cheap or expensive? The way they get valued is based on their earnings, and they get multiplied. Say, well, the earnings for all the companies in the S&P 500, you put all those companies together, it's about 13.3 is the average. And that, if that's sustained, you know, if it continues, if the earnings continue to grow, then, you know, we shouldn't have too bad for the next, you know, 10 years average of returns in stocks. But, you know, a lot of that depends on the economy. If the Fed takes the punch bowl away with all the quantitative easing, we might have some trouble. And the U.S. consumer has been remaining pretty resilient. So we'll see. We'll see what happens this year with the tax increases, whether that's going to continue. So what to watch? Our top 10 for 2013. We're seeing how, you know, political action, what's going on in Washington. You know, how many people here think that they're going to be able to come to some kind of resolution next week before March 1st? We've got one optimistic person, yeah. It doesn't look very likely. It looks like that sequestration will probably take effect. And the tough thing about that is, you know, you have the increase in the Social Security tax, you have the cuts in government spending, you know, and you have an increase in tax, the income tax rates. That's not a good thing to have all at one time when we're in such a kind of fragile state still. So sentiment, it's definitely going to affect business confidence. And, you know, I mean, it's what, down here in the bottom it says, Henry Ford quote, whether you think you can or you think you can't, you're right. Right? If you think you can't, you don't even bother trying. So you're not going to, if you're a business owner, you're not going to spend the money. If you think, oh, this isn't going to work out, I'm not going to do it, you know. If you think you can, so that's been part of the, I think what the Fed's been doing, trying to keep the stock market up because they feel as long as that's up, people feel good and they'll spend money. If it comes down, then people get scared and stop. So since, you know, they can't make the housing prices go up. Okay, and then there's geopolitical risks. So we have, you know, some extreme ones, South Sudan, Yemen, Syria, and then we have the ever-present Iran. So we've got some things going on. Of course, it's all about the Middle East and the oil and, you know, getting through the Straits of Hormuz if those were to be closed down. So every now and then that really spikes up and that causes oil prices to rise, et cetera. And then we've got Helicopter Ben there. Wish we would fly over Harleysville. As it says here, don't count the central banks out in 2013. So they seem to always find more things to do to try to spur the economy. So, and we do have pretty much all the major countries of the world are printing money. So we'll see how that works in the short run anyway. And then the new leadership in China, and their top priority is to remake the economy, and they want to rely more on domestic demand, less exports. So they appear to be willing to see slower growth. You know, be more sustainable for them. I think this chart's interesting here is the contribution of Chinese demand to world consumption growth. So corn, iron ore, soybeans, I mean, the growth, you know, is pretty substantial for all of those things. So, and then onshoring. Does anybody know what onshoring means? That's where jobs come back here. Come back here instead of going overseas. That's what it means. Yeah, so you can see the number of years where manufacturing jobs are going overseas may begin to reverse. And what this shows is, you know, wages in China and then the transportation costs, right, to have to ship the goods from there back to here are outpacing. The savings are not there as much anymore. And you can see the graph on the right is showing how it's slowing. And the energy revolution. You know, there's a lot of debate about fracking and, you know, all that, but I'll tell you what, it's definitely making a difference. So America met 83% of its energy needs in the first 6 months of 2012. That's a big deal. That's huge. I mean, you know, you go back to 1960, you know how much money has left this country and gone to the Middle East? I mean, where did all their wealth come from? I mean, they have oil, but they get our dollars, you know, they get euros, they get, you know, yen. It's projected that the U.S. will be the largest oil producer in the world by around 2020. Isn't that amazing? That could be a boom for our economy. It really could. It really could. There's a lot of jobs. So you go up to like northeastern Pennsylvania, South Dakota, you know, different areas. It's booming. Booming, booming. And there's a pipeline that's in Maryland, goes out to the coast there. For the first time, it's going out. Instead of it being delivered and coming in, it's going out and being shipped out of the country. So, and there have been a lot of money spent on ports in this country, too, in the last couple of years to be able to do this. So that's a real positive. Yeah, and then, you know, the other thing is corporate bank balance sheets are still very healthy. Very, very healthy. So we can see here they've stockpiled over $1.7 trillion of cash. And look at that graph. I mean, just, you know, we're starting to see, like the other day, Berkshire Hathaway announced, Warren Buffett's company, that they're buying Heinz. Okay, so we're seeing more of that, mergers and acquisitions, you know, which is great, but you don't have as much job creation in those types of situations. You know, it's better when it's being put into startup companies, new technologies, et cetera, to be able to build the job growth. So that's what companies are doing. They're using their cash to buy other companies. And weather. So we've seen some extreme weather. And the Midwest had that horrible drought last year, and that definitely affects things. That's going to affect things for a number of years to come. And last, stop watching CNBC. Because they are there just to evoke your emotions and get you all worked up and keep you watching. But emotional investing is not the best way to invest. So check the facts. So, closing thought, keep calm and carry on.